Welcome to the daily update, where I'll go over the action in the market for Thursday, March 6th, and we'll see how things look for Friday, March 7th. Another down day. The subtle improvements that we were seeing after Wednesday, those are pretty much gone right now, and things have switched back over more negative. We're really dealing with the 200-day moving average. We actually dropped down below it, but we were able to come back and close slightly above it for the S&P 500. And the market's at a real tipping point right now with the biggest economic report of the month coming out in Friday's session. That's the employment situation report. So we'll see. There's been a lot of anticipation over this. There's been some concerns because of what's going on politically and geopolitically. And the market is on edge, to say the least. But we haven't quite switched over to a much more negative stance yet. Some indexes already have. NASDAQ's in correction territory since it's down over 10% right now. We're down about 6.5% or so with the S&P 500 on a closing basis. So yeah, things are not looking really good right now with the tariffs and the cuts from Doge and just the unsettledness as things are being changed right now. Okay, so let's go back and talk about what happened. Right at the open, we had a gap lower open. We drifted down, down, down. The futures were showing some weakness, and we opened up below S1 and quickly went down below that level at 57.70. Then we tried to set a base not too long after the open at about the 57.50 level. This played a critical role in Wednesday's session. That was the low. And we were able to rebound and get up to about 5,800. Notice these are round numbers. So, yeah, the market kind of fixates on these things. Then things started to get more negative. We declined back below S1. We went below 57.50 this time. We went below the 200-day simple moving average, but we were able to close just a little bit above it. So we were down 1.78% on above average volume. We are still negative in the short and intermediate term. We're starting to look a little, well, quite a bit oversold in the short term, but that could also suggest negative momentum. We're seeing a little bit of an increase of the list in the intermediate term. We're still positive in the long term, but there's kind of a two-phased approach I use for the long-term trend. One is, are we above the 200-day moving average or below it? That's positive or negative. And then I use a moving average crossover with a 50 period moving average and a 200 period moving average. And we're still positive in that regard. If things continue to show more weakness, eventually we'll see a negative crossover. That's called a death cross. So, but we're not there yet. That'll take some time to actually play out. Interest rates are going back up, and we're still under that 4.5% level with the 10-year yield. But going up, that can put some pressure on stocks, and the dollar just continues to get hammered right now, which could be positive for stocks, but they're kind of decoupling right now. The dollar was doing what it's doing, and stocks are doing what they're doing. Sometimes there's more of an interaction between the two, but not right now. Just like a week ago, 2 weeks ago, if interest rates were up, stocks were down. If interest rates were down, stocks were up. And then we now seen that not be as strong of a relationship as it can be at other times. And then all the things going on with the cuts, and there's been threats of bringing the hostages out of Gaza, or things are going to get really nasty, and just everything that's going on right now, and then all the tariffs as well. All right, so we closed slightly above the 200-day moving average for the S&P 500, and now we're below the 200-day moving average with the NASDAQ 100. If you watched the video for Thursday, I was watching the NASDAQ 100, the S&P 500, the large cap growth ETF, the Wilshire 5000, and then the total US stock ETF. All of those were hanging out right around, but a little bit above their 200-day moving average. Well, a lot of those were lost, and I have charts to show you of those, but some are still hanging on. The NASDAQ is now down 10.4% from the all-time high that was set, and now this is classified as a correction. So that turns things more into a negative definition. And Commerce Secretary Lutnick said that the USMCA compliant goods and services will be exempt from new tariffs for 1 month. That could have been positive for the market, but no, the market just decided it wanted to be negative anyway. And around 62% of Canadian goods and about 50% of Mexican goods are still subject to the tariffs, and goods that are exempt, they will face tariffs starting again April 2nd. So yeah, and the debate goes back and forth whether this is good or bad. Some people think, well, this is all bad. We shouldn't be messing around like this. But on the other hand, it's like things have been broken for so long, they need to be fixed, and it's short-term pain, long-term gain. And you can come out wherever you want to come out. It's just this is the way things are going for right now, and it's probably going to produce some issues. And then the other part of the debate is, are we actually going to go into a recession? And that's a debate that goes back and forth too. And we're watching the data with all of this as well. Mega caps didn't have a good day. There was a little bit of spark of hope on Wednesday. Growth had done a little bit better. Mega caps were doing a little bit better. Not that we could really see a big shift, but at least a bit of an improvement. That didn't carry through to Thursday. The VIX is still above 20. We're at 24.87. And as I pointed out many times, when we're above 20 with the VIX, that's when we get negative annualized returns. And so, yeah, this just means there's a lot of fear in the market right now. Now, here's our short-term list. We are going up pretty quickly with the VIX. So the VIX, based on an RSI 9 period, that's extreme now. The Stoke RSI and 1% are, which had fallen off after Wednesday, they're back on the list now. CCI 14 and 20 were still on the list, but they're even more so on the list now. Stochastics, standard deviation, we're down into the -3 channel because we've been going down pretty fierce here. On a momentum basis, our short-term oscillator, the slope oscillator, it's extreme negative, and we're still far away from the 20 period moving average. Intermediate term, starting to see a bit of a list building here. The TTM squeeze is extreme negative. Now that was there after Wednesday, and it's a little slower, and so it's still catching some momentum. Even with the nice day that we saw on Wednesday, this still kept going down. And now another one here is the rate of change going back 10 periods. And then the Sean trend meter is starting to get extreme negative, and we're getting far away from the 50 period moving average. We still have a non-confirmed Hindenburg-Ullman right now. We had the initial signal, and we've got until March 31st to get the other signal. I'm not going to show that chart unless we get a confirmation signal there. No change to the scenario concerning the Fed. We'll see if the employment report on Friday adjusts that at all. The dollar was down and just getting really hit hard lately, and interest rates were up. We're at 4.29% with the 10-year yield, where we had been at 4.27%. Sentiment, man, we're pretty negative here, down at 17, where we had been at 22. We're below 25, and that's when fear is possibly getting too far extreme. We've been down below 25 now for a number of days, so we're kind of camping out in this extreme negative area. And we're still inverted with the 10 to the 3-month yield. I won't have a chart to show you of that. I'll just mention it here, and then if things change, I'll bring up the chart in the daily video. We are negative with our trend. We're above 20. We're above the moving average. The red line's on top. So that is a confirmed negative trend. With the down day, our bias is negative, and the last number of days together, our momentum is negative. So we did get the trade balance. Now you can see this really jumped here, minus 131.4 billion. This could be some maneuvering ahead of tariffs that are kicking in here. So it was much more negative than expected. And then the weekly jobless claims came in. This is still holding up. They expected 234,000. We got 221,000. So this suggests economic strength, at least when it applies to the job market. Last time it was at 242,000. So these are actually coming down. And I'll show you a chart of this one. The continuing claims are going up, 1.897 million, where it had been 1.855 million. Then we had the revised number for the fourth quarter productivity. They expected it to come in at 1.2. It came in at 1.5. So that was a little, actually, this could be economically good that there's more productivity going on. And the labor costs actually were down. So there's a little bit less of a cost here. They expected it to be at 3%, which is what we saw in the first reading. Now it came in at 2.2. Wholesale inventories up 0.8%. They expected 0.7% of an increase there. Last time it was down 0.4%. Okay, here's the chart. We look at it every Friday after the claims come out on Thursday, where this is dropping off. The moving average is starting to flatten out a little bit here, where we were starting to go up. Now we saw a real drop. But now we're seeing a continuation here of the folks that are unemployed for longer than 1 week. That's beginning to pick up a little bit. And then this will be updated again on Friday because we'll get the new unemployment rate. And this just tries to put everything here on the same chart, just to give a little bit of a context there. All right, then the nominal trade, the trade balance, it's really going down. And this is a 3 month average here. And it could be because of, as I said before, maneuvering due to tariffs that may be kicking in. Nominal exports and imports, where we're seeing a real pickup here. The yellow line, that's imports, and a little bit of a tick up here with exports. And the trade deficit really dropping off here. The productivity and unit labor costs year over year, both are coming down. When you look at them annually, we're going down with the productivity. That's the blue line, and down with the yellow line here, the unit labor costs. Wholesale inventory is really picking up, maybe a little stockpiling going on. Again, this is just speculation, but we are seeing some rather big swings in some of these numbers. Okay, now here's GDP, and then we compare that to the earnings per share on an annual basis of the S&P. And you can see there's a pretty strong correlation here, just to kind of show where we're at with this one. And then this, is this a good sign? The S&P performance after 5 consecutive days of a 1% daily move and all of the above. And when this happens above the 200-day moving average, going back to 1950, and I took this smaller area and tried to blow it up here. Here's all the green diamonds here when these types of things happened. And what was the performance going forward here? Well, a month later, we were up 75% of the time. 3 months, 83 and a third percent of the time. 6 months out, 91.7%. Then we dropped back a little bit to 81, almost 82%. So when you have a lot of this correction going on and it's above the 200-day moving average, and we're still there right now, that could change after Friday, then it tends to be forward looking more positive. Okay, then the annual return versus the annual return when you take out the best 10 days here, this you might want to just pause and look at this. This is just a different way of maneuvering around some of the different data. Okay, then DAX, Germany's just been doing really well these days, and it's trading above its historical median here, while the MDAX is at its historical average. And this is just showing that the ratio here with the PE ratio, looking with their forward earnings, it's still not necessarily all that high on a comparative basis here compared to the US over here. And then this is the NDR global recession model. It's the lowest that we've seen now in quite a while. It just means, according to this, there's not necessarily a concern of this of the economy going into a recession. And then not the Trump trade as advertised. Yeah. So we're seeing things down. This is how things have been performing since the inauguration. And of course, people that hate Trump are just going to jump on this and use it as justification for even more hate. People that like Trump, they're like, well, just give it some time. It's like going in for surgery. You got to be cut open sometimes, and it's going to hurt, and you're going to be in some pain, and you're not going to be very comfortable there for a while, but down the road you'll feel better. So it just depends on the perspective of things. Then confidence is also usually, it usually follows the equity markets. So we've been going down now with the S&P, and the markets as a whole, and that may take some CEO confidence down with it. And then the sentiment indicators coming right back down here to this dashed line, which is a little bit over 50%. And it's probably dropping. This chart's probably a few days old here. Okay, now job cuts by reason. And kind of the takeaway that I got from this is they're coming from Doge. Now, if you voted for change, if you voted for Trump, then you really like this. All these cuts that are coming out and they're going into these government agencies and laying people off. Okay, you like that. But then the attitude that a lot of us end up taking is, well, yeah, I believe in all these cuts and yeah, get rid of this wasteful spending. Just don't cut my stuff. When it starts to hit personally, then things tend to shift their attitude really quick. But it is just based on this graph that I found here, just showing that, yeah, that's where a lot of the cuts are coming from. And then the FOMO fear is gone. FOMO is the fear of missing out. It's when you have people with their smartphone and they get some brokerage app and they're buying and selling Nvidia. They don't know anything about it. They don't even understand what the company does, but all their friends have been talking about it. So they're whipping in and buying their 5 shares here, their 50 shares there, what have you. That's pretty much gone now. And here are the big stocks: Nvidia, Microsoft, Apple, Amazon, Meta, Tesla, Alphabet, the high flyers that are called the Magnificent Seven. We're really seeing a lot of fear coming in here because they're not necessarily doing what people thought they were going to do. And instead of making money, people are losing money right now as these stocks have been under pressure. And then how does the NASDAQ 100 perform? And I have the actual explanation here. It closed below its 200-day moving average for the first time in over a year. Watch the next 2 weeks. Every time it lost the 200-day moving average after an extended run and suffered at least a 3.5% drawdown. So that's what we're watching for. Are we still going to go down another 3.5%? Within the next 2 weeks, it led to a bear market, which means we're down over 20% at that point. That's the definition of a bear market. But when it was less than 3.5%, we were positive every time, going out a year into the future. So this is just one of these things that we'll be watching for is, are we seeing a real shift to a longer term decline with the stock market, or is this just some freaking out that's going on? We're going to get this dealt with and then prices will go back up. That's kind of where we're at. And this just shows, okay, let's watch the NASDAQ 100, which I watch every day, but we'll be keeping more of an eye on this with the over the next 2 weeks. Okay, here's our chart where we did gap lower and then we tried to bounce back up here, never even made it up to the daily pivot. Got back up to this 5,800 level, again, a nice round number, before we really started to come down. And now we're dealing with the 200-day moving average. We actually dropped a little bit below it, but then we just kind of treaded along here. And there are millions of people who know what's happening right now. They're watching charts like I'm showing you, and they know this is the line in the sand, at least part of the line in the sand, to be positive or negative. And if we drop below and close below it, that's going to turn things more negative. Now, the NASDAQ 100, some other indexes, they already have. But this is considered to be the benchmark. This is the S&P 500, and it measures the overall stock market of the US. And it's just teetering right now at that point where we could slip down and go negative, or we could eventually bounce back up and turn more positive. And the market needs to do this from time to time. This gets rid of the weak hands. People that don't really study the market, they don't have the time or even the desire. They just see, whoa, we had 20% return in 2023, 2024. We elect a new president who's a businessman. Yeah, it's going to keep going up. All right. Well, all that's being doubted right now, and that's what the market wants. It's like you don't want to take the stock market for granted. You have to have a healthy respect for it. It's not a cash machine that's automatic. It might be longer term, but times like right now are when it's like, well, maybe this time things are going to get kind of ugly. Because there's a lot of people, if you go back to Monday, they were buying up here. And we were at 59.50 at that point. Now we're down dealing with 57.50, right around there. I mean, it's a pretty significant drop that people are seeing in just a few days. Okay, then the intraday chart here. where we actually started, we were pretty much flat. And then Europe opened and boom, that's when everything started to go negative. We tried to bounce back up during the cash session. We went negative. Not much of a change. There's probably going to be, again, I say this and then the opposite ends up happening. I thought Thursday would be kind of quiet because of Friday's employment situation report. Thursday was anything but quiet. So I don't anticipate the futures showing an awful lot of movement before we get the report an hour before the stock market opens. But something could happen, the market could decide to react, and that could always change. We're still looking more negative here, where we see the red line, which is value above the blue line, which is growth on an intraday chart. Now, yesterday I pointed out, it looked like, oh yeah, looking a little bit better here with our S&P growth to value intraday. We lost all that. We're right back down to where we were a couple of days ago. So that pretty much got taken off the table, at least for the short term. End of day, growth just got hit really hard. 2.87% decline, where value was down a little over 0.5%, down more with the mid caps, down more with the small caps. Then the middle area, these are the corresponding ETFs like SPY, MDY. I forget what the small, it's a new one that I don't follow as much. Then looking at the end of day chart here with the small cap growth to value ratio, we actually came back above the 200-day moving average, but it did decline here as the small caps have just been going down, down, down. They should have been going up, 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 according to what people were thinking back in December. And we're seeing a similar thing here with the mid caps. We're coming back down. We're actually testing the 200-day moving average with the growth to value ratio here. And we're dropping below the 200-day moving average. This had been holding up a little bit better. Not on Thursday. We're seeing this ratio really coming back down, even though it's still in a longer term uptrend. And I pointed this out as a little glimmer of hope after Wednesday. No, we're back down underneath the rainbow when we look at the growth versus value ETF. And not really seeing much of an improvement here with discretionary to staples. Longer term uptrend, but lately really been going down with this. And it's discretionary going down and staples going up. Discretionary is more growth oriented, staples are defensive. And if they show some strength, that means the market is possibly switching into more of a defensive mode. And that's what we've been seeing for the last week to 2 weeks. And this was another area that I was watching on Thursday, the 200-day moving average with the large cap growth ETF. We're now under the 200-day moving average. And our trend is negative, but it's interesting though, even with the down day, you see how the red line declined, but it's still on top. So we're negative. We're above 20, we're above the moving average. A confirmed negative trend that's getting stronger. And short term, also, red line came down a little bit, but we're also in a confirmed negative trend in the short term. Dropped off a little bit, but still above average with volume. And this fear gauge is continuing to go up. The ulcer index, we're really going up here with the VIX. We're well above 20 and rising at the current time. Also going back up with the VIX of the VIX. The momentum of the VIX is up, which is negative for stocks. We're possibly getting a little extreme. The VIX using an RSI based on 9 periods, we're back above 70 now. Yeah, we finally dropped out of this red area. For a couple of months here, the market had been expecting some kind of a big move when we're in this red area, and now we've dropped down. So if we don't go back up into the red area, I'll finally get to stop showing this chart. We went up with this fear gauge. We're up with the other fear gauge. That's a confirmation there. Had the weekly reading of individual investors. They were very negative in the last reading. They're even, well, they improved a little bit here, but they're still extreme negative. And when they get down to an extreme reading, this is when, like the sentiment gauges that we follow, that's when we consider using them as contrarian indicators. Well, we've seen this down here for 2 weeks now. And we're still going down with the risk on versus risk off ratio. And this is going down. That means the market is getting more defensive. But we actually declined a little bit here with the volatility risk premium. We're coming down back into the band. And the advanced decline line's holding up fairly well. That could be part of the rotation going from growth to value. So we're just kind of trudging along sideways where we did see a bit more of a decline based on volume. We're below zero and declining with the advancers minus decliners over the last 10 days. And we're seeing a little more weakness here. And it's not that we're seeing an expansion of new lows or even an expansion of new highs. We're not seeing much of anything right now. The market's just been treading around after setting a big number of new highs and also new lows. The last couple of days, we've just kind of been muted here. But that's sending our 5-day down, and our 10-day is still going down here, dropping below the midpoint here with our short and intermediate term advanced decline ratio. We're still coming down slightly above the moving average with accumulation distribution. So we haven't quite switched over negative with this indicator yet. It'll turn negative if we drop below the red line. But we're negative here with our other smart money indicator. We're declining with the red line going down. And where we had been turning more positive after Wednesday, we're back to turning down here with our third smart money indicator, the chicken oscillator. The vortex is negative with the red line going up and the green line going down. But we're not seeing huge changes here. The advanced decline line on a cumulative basis for the S&P just kind of chopping along. We're seeing a little bit more weakness here based on volume. Now, on a cumulative basis for the NYSE, we did drop below the moving average, but we're just a little bit below the moving average here with our regular NYSE advanced decline line, as well as this other NYSE advanced decline line. We break it out based on common stock. We have been declining here, both based on price and volume, and we're still positive though. When we just look at the S&P 500, we're declining, but we're still above this moving average, where we're seeing more of the weakness in the NYSE common stock, the mid caps, and the small caps. And we're negative here with the 5-day moving average of the highs and lows across the broad market. This continues to decline. And we look at those stocks inside of the S&P above their 20-period moving averages, below 50 and declining. 50-day moving average study, declining below 50. We're really going down here with the 100. And this is even potentially more negative. We now have less than half of the stocks in the S&P above their 200-day moving average. We dropped below 50 now. And this is another way of showing that same thing. This is the percent of stocks above their 200-day moving average with the S&P. We're dropping below 50 here. And we're coming down. Now, on a closing basis, we're still just barely 0.14% above the 200-day moving average. So do you think Friday is going to be important? Let's hope it's a report that the market can react to instead of one part strong, one part weak, and the market doesn't know what to do. Let's just hope that there's a little, at least that's what I hope for, a little bit of conviction to actually, okay, if we're going to turn negative, fine, then just be a negative report and have the market freak out. Or, oh, gee, things are better than we thought, and have it be something that the market can actually react to in a positive way. All right, but that's dreamland. That rarely ends up happening. We're also seeing here where we're testing the 200-day moving average, and this is a tipping point right now. We declined a little bit here with the 20, 50, and 200 period moving averages. We're getting far away from the 20 period moving average and the 50 period moving average. And we're showing negative momentum here with the Stochk RSI, the Williams percent R, CCI 14 and 20. The stochastics, extreme in the short term, intermediate short term, and long short term. And the force index is not extreme, but it is negative. It didn't quite come down to the Keltner band here. The condition of the short-term trend continues to show weakness here. And we're below the 20-period simple and exponential moving averages. We're in the -3 channel with our standard deviations chart. We're negative with the balance of power, negative with the go, no go, negative with the lowest low value. And then these are just some attempts. Now, I do this on an intraday basis, not a closing basis. But if you look at the chart from the all-time high that we set just a few weeks back and how far we've declined, it would be 7.1%. But again, I don't use a closing value. I go intraday here. So it's a little bit more than, I think it was 6.6% on a closing basis. And if we come down and end up falling below 10%, that's when the S&P then would be in an official, at least by definition, a correction. And here's the TTM squeeze. It keeps on going down. We're below this black line. And this is a longer term look at the TTM squeeze here, below the black line as well. And this is the rate of change going back 10 periods, because this is when it was about 10 periods ago when things started to turn much more negative, and we could be a little overextended now. And we're going pretty fast, even though the standard deviation is coming down. We're well above the moving average as the speed has been pretty quick. That's what this measures here. We're negative with the ease of movement based on 14 periods. It's below zero and declining. We're negative with the Arun. We're below zero and declining. And the McClellan oscillator below zero and declining. It's like a broken record here. We're going down with the summation index based on price and volume, and we're just starting to cross below the midpoint. When we look at volume, negative and declining with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume. This is interesting. We're actually showing something a little bit positive here with the Swindler trading oscillator. We actually went up a little bit. We're still below zero based on price, and we're going up and flattening out a little bit with the Swindler trading oscillator based on volume. Is it seeing something positive that our other charts are not seeing? Now, sometimes this gives us some good insight. This is why I don't treat this like a primary indicator, but I don't really put it in a secondary indicator status either. It's kind of right in between, because sometimes this is really, really good at giving us some insight. Other times it just is completely wrong. All right, on a momentum basis, we're clearly negative. With the PMO going down, we're going down based on price and volume. We're going down with the PMOs in the S&P that are rising. We're going down with the buy signals. We're going down with the PMOs that are above zero. We're negative with the Elder's Impulse System for the S&P with a red bar. We're negative with the parabolic SAR. We're in extreme negative here with the slope oscillator. This is a short-term oscillator. Also starting to get possibly extreme here with the MACD. These are some pretty low readings based on what we've seen in the recent past. And on a momentum basis, though, we're just down. Short, intermediate, and long term. Copic curve, negative. Starting to get extreme negative with the Sean trend meter. Below 50 and declining with the money flow, as well as the ultimate oscillator. Dropping further below the moving average with unbalanced volume. Declining, but not extreme with the RSI 14, and even the short-term RSI 9 is not quite extreme negative. The condition of the intermediate term trend continues to be negative. We're below the 50 period simple and exponential moving averages, below the 100 period moving averages. So we put them all together. And yes, we're testing the 200-day moving average, and we're just barely above it right now. Friday's going to be an interesting day to watch. Looking at some anchored moving averages here, I'm following this blue line. Even though it's below the 200-day moving average, this could be some support that if we go down, the market may be able to bounce up off of. That's based on the low that we saw back in April of 2024. And we are potentially gearing up for a signal here with the mass index. We're above the red dash line. We're coming up to the blue line. When we roll over and drop back down below the red dash line, that this indicator tries to suggest that there will be a reversal. And we've been going down, which has been starting to trigger this. So that would mean possibly a bottom at that point. And we're just about ready to see a buy signal here with the praying bottom fisher. So we've got some things lining up that could turn us more positive, but maybe more of the market needs to get freaked out first and just convinced beyond all doubt that we're going down. That's usually when the market bottoms and then we start going up. But we're still negative here with the bullish percent index below 50 and declining. We're declining with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. We're below the Ichimoku cloud. We're turning more negative with the green line going down, and the blue line and the red line are also going down. And watching this other fib level, kind of not too far from that anchored moving average that we have. So if we do see a little bit more weakness, do have a couple of support levels that are below the 200-day simple moving average. Because usually how this works is you probably have a lot of folks that are setting up stop loss orders right under the 200-day simple moving average. And we might blow through that enough to get all those stop loss orders triggered, clear them all out, and then turn and go up. I mean, that is add insult to injury there, but that's how it works sometimes. And we've been running into problems here. We back in December and even into January, And then into February, we would hit the upper end of this long-term trend channel, and then that's producing some real loss of momentum that's now turning into more of a decline. And we're negative with the hike in Ashy with the dark candles. We're negative with the Kegi, red and pointing down. We're negative with the Renko chart, and we're negative with the three-line break. So lots of confirmation that we are in a downtrend now. Long term, dropping further below this 250 level with the 150 period moving average, and we're just a little bit below here with the 200 period moving average. And we're negative in the short and intermediate term. We've seen this for a few days now. And we're positive with bonds in the short and intermediate term. We switched back to negative in the short term with commodities. The dollar is now in a short and intermediate term downtrend. And all the sectors were negative except for energy and staples, which these tend to be more defensive. With tech leading the way lower, discretionary was also down, communication. These are the three big growth areas. Financials were also down. They've been taking a bit of a hit lately, too. Nothing but red here. It's like Valentine's Day. We had healthcare having a BPI cross below 50, and then we just count it down. NASDAQ below 18.5, 4, 3, 1, blast off at 18,000 here. And we crossed below 5,800 with the S&P. Let's see, the real estate had a bearish MACD crossover. Now that's more defensive. It's actually turning more negative. Oil sets a new 52-week low. Now you like that if you got to fill up your car or something, but it's not necessarily as healthy when it comes to the market. So we're just kind of last few days been going sideways here with the Dow. It was down about 1%, but it's not seeing an awful lot of weakness. However, it's still below its 50-day moving average, but above its 200-day moving average, and it's still in a longer term uptrend. But we're negative after being neutral with the diamonds for the Elder's Impulse system. We're dropping below the NASDAQ. We're back underneath the 200-day moving average. We dropped it. We came down last week and bounced up off of that. Then we fell below it, only to come back above it. Now we're back down below it. So kind of a teeter. This is like World War One trench warfare going on here. And now, this is something I was watching. We were holding on to the 200-day moving average with the NASDAQ 100. We're now losing that as well. And we're negative with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is negative. And here it shows the Qs dropping below their 200-day moving average on a closing basis. Small caps just continue to go down. And we're going down with the Russell 2000 small caps as well. Neutral to negative with the small caps with the Elder's Impulse system. Mid caps also seeing a lot of weakness now, though they've been holding up a little bit better. But they've gone from neutral to negative with the Elder's Impulse system. This is an area we want to keep an eye on. We were holding out around the 50-day moving average. We've now dropped below it with the financial sector. But now the banks that are inside of the financial sector, we're coming down to the 200-day moving average here. That's the red line. And so far, this area is holding. The Wilshire, I was watching this. We were watching the 200-day moving average here. We lost that on Thursday. And we're right down to the moving average here with the total US stock ETF. So that support is still barely hanging on. The moving average is at 131, and we closed at 125. So I guess we're just a little bit below that. We closed at 125. Yeah, so we're a little bit, I'm sorry, 124 is the 200-day moving average. Just little teeny tiny bit above it right now. And this is what we've been watching too. Staples, defensive versus tech, growth. This ratio is still starting to go up. We're coming right down to the 200-day moving average with the FANG index. This is another way of measuring the Magnificent Seven, the really big stocks. So there's still a convergence of support that we could bounce up off of. But if we lose this, that obviously is going to turn things more negative. Apple was down a little bit. It's below its 50-day moving average, where we have Amazon still down to its 200-day moving average. Microsoft's in a downtrend, and it was down a little over 1%. Google coming back up to its 200-day moving average, and now that could be acting as overhead resistance. Dropping below the 50-day moving average with Meta. My goodness, down 4.35%. We were down 5.74% with Nvidia. This is the darling stock that everybody loves. Well, you get your smartphone out, buy your 12 and a half shares or whatever, and it's going down. And that's what the market wants, losing faith that things could go up. Okay. It's weird psychology that goes on there. Of course, Tesla's down. It's dropping below its 200-day moving average. Netflix, which has been one of the better looking stocks, my gosh, 8.5%, falling below its 50-day moving average. And we're seeing a bit of a deterioration here when we compare US stocks to world stocks, both in the short term and longer term, looking at the correlation. Oil dropping down here. It continues to fall. And the dollar's dropping below its 200-day moving average. We were just up into the 108 range a few days ago. Now we're going down into the 104. That's a big move for the dollar. And we're going back up with the 10-year yield, but we did close well off of the highs. We're going back down with the 10-year based on price, and we closed a bit up off of the lows. And we're keeping an eye on the 10-year yield in Japan. It's back to going up. I didn't show this chart for a day or two because it was going down. Now, this is a weekly chart. So if we look down on the week, then I don't show it. But if these rates are going up, this is what caused all the problems last summer. But so far, it really hasn't been an issue. There's other issues that the market's freaking out about. Looking back to week again here, and even more week, where we saw a little bit of an improvement after Wednesday with our growth to value ratios. Now, going down with the Qs to S&P, discretionary to S&P, large cap growth is underperforming large cap value. Going down with the large caps, mid caps, and coming back down. We saw a big bounce up after Wednesday with this ratio, and it's coming back down below a declining moving average here with the small caps. This is also spiking back up, meaning the market's getting more defensive. Staples are outperforming the S&P. So what's the outlook? We are negative in the short and intermediate term, and we're slightly above, it should be the 200 period simple moving average. The employment situation report, that's the biggest economic report of the month, and that's what will be coming out an hour before the open on Friday. And then we'll get consumer credit later on in the day. Okay, hit the wrong button there. And then all the crazy stuff going on. And what's going to develop between Russia, Ukraine? What's going to happen with the U.S. and Zelensky? What's going to happen going on in Israel? And then anything else? The tariffs and all these things that are happening these days. And then here finishes out the calendar for the economic reports. This breaks it down to different parts of the employment situation report that will be coming out. I just treat it as one big unit. Oh, and then Chair Powell is supposed to speak. And that could freak the markets out or give them some hope. All right, seasonality, we're neutral to negative with the Dow and S&P. We're flat out negative with the NASDAQ. So not an awful lot of historical positive things to hang on to for right now. But this is not 100% or zero. I mean, this means 33 and a third percent of the time the Nasdaq's up. So, but well, okay. And then we look at it, we compare regular years, those are the solid lines, with post-election years. We actually see a little bit of positive seasonality for the next couple of trading sessions here in March, but where it's more negative when we look at all of the years together. And we're supposed to be in the first half of March. Well, we are, but this is the second best performing part of the year, going back to 1950. And tell that to Thursday and possibly Friday, where the second half, that's where we still do well, but not as well. And March, and this shows you the returns for March, April, and then into May. And this also suggests that things could be a little bit bumpy until we work our way into April here. Now, we are seeing a mixed picture right now with our smart money indicators. We're at the moving average with accumulation distribution, where we're declining with the Chaikin money flow and the Chaikin oscillator. And we're negative, and the reason these are gold is they're primary indicators. We have the S&P and NYSE McClellan oscillators and summation indexes. We're negative with the parabolic SAR, the bullish percent index charts that we follow. We're negative with the momentum oscillators for the S&P. Our moving average studies, all of them are below 50 now, and we're dropping below 50 with the 200 period moving average study. And the ease of movement, the money flow, ultimate oscillator, the vortex is negative, and the momentum for the NASDAQ 100 is negative. Where longer term, the growth to value ratios are still showing an uptrend, but man, they're just getting hammered here in the short term, and they've actually turned more negative. And I don't know about this, these charts just were not updated. So disregard this bullet point here. And we're still above the moving average with the S&P 500 advanced decline line. The other indexes have fallen below. So I guess if the S&P gives up the ghost and drops down, then we might see things turn more negative. Swollen trading oscillator, it's actually showing something not negative. It's not really screaming positive, but it's not negative. The financial sector is positive longer term, even though I got hit hard, but the banks are now testing their 200-day simple moving average. So our conclusion, negative in the short and intermediate term for right now, at least according to are we above or below the 200-day moving average, we are still positive in the long term. We're becoming more oversold in the short term, a little bit oversold in the intermediate term. We're still positive right now, and that's because of the golden cross. The 50 period is still above the 200 period. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.